If you are a new investor, here are four critical things for you to consider. The first one, have you built an emergency fund? Building an emergency fund is crucial and an integral part of a success for an investor. The main reason behind it is that while you want to expedite your investment in the stock market, you don't want to take unnecessary risk. Imagine the scenario whereby you put a lot of money in the stock market and your portfolio is doing very well, but suddenly some unexpected things happen whereby you need to borrow money, you need to cash out some money to pay for those unexpected costs. In this case, if you have failed to build in a safe emergency fund for yourself, you're going to struggle because now you have to suddenly possibly sell some of your holdings, whether it's a ETF or stock. And depending on how the performance of those funds have been, you might really set yourself up for failure. And that's not something we want. To be kind of more reassured, we want to make sure you build a healthy emergency fund. Now, what is a healthy emergency fund? It can really differ and kind of vary from one person to another. But as a general rule of thumb, typically anywhere between 3 to 6 months worth of your monthly expenses. So 3 to 6 times of your monthly expenses would be a safe, fairly safe kind of balance. Imagine the case whereby your monthly expenses, when you add them all up, is around $2,000 per month, just for the sake of an example. In this case, your emergency fund should be anywhere between $6,000 to $12,000 saved, perhaps on the side in a high interest rate savings account, really not with the intention of growing it too much, because we know high interest rate savings account, a lot of times the interest rate might really not keep up with inflation, but it's there for you in case you need that money for an emergency, as the name suggests. The second big thing for you to consider is what is your time horizon? So, what is the time frame that you are considering putting away this money into the stock market? If you are going to be needing this money in a short period of time, I'm talking about, let's say, 1, 2, or 3 years, that's considered relatively a short span of time for the stock market. Then maybe putting it into stocks or even ETFs for that matter, may not be really the greatest and safest way to approach it because the stock market has its ups and downs. Well, historically, over a long enough period of time, stock markets tend to grow and tend to go up. Over a short period of time, it has definitely some volatility. So it might be really risky if you need the money, let's say, for a down payment to pay for your wedding or for an anniversary or for a travel or even maybe even use it to buy a car. Putting it in the stock market for such short period of time can be quite risky and may not be worth it. So definitely clarify what is your time horizon. Now, on the other hand, if let's say your time horizon is much longer, say 8, 9, 10, or even more, then investing in the stock market may be a more suitable kind of avenue because that's relatively longer time period. Even if there might be stock market crashes or stock market like pullbacks over a longer period of time, it has more time to recover. The third thing for you to consider is what is your risk tolerance? And this is different from one person to another. For me, as an investor, I've been investing in the stock market for several years, almost a decade now. And over time, I've built in kind of the thicker skin. I consider myself more of an aggressive, higher risk tolerant type of investor, whereby if the stock market, for example, does poorly, I don't panic. In fact, I see those as more of an opportunity to buy more into high quality ETFs that I have in my portfolio. Whereas for somebody else, this may not be the case. For them, maybe the moment the stock market has a red day, like it's performing worse than, let's say, the day before, they might start panicking. They might really kind of want to sell everything, or they are not happy with it. Or maybe they can't sleep at night. All of those considerations are to be taken into account to determine what is your risk tolerance. And the risk tolerance comes to play for deciding what type of investment you're going to be investing in. Because when we talk about investing in the stock market, there's so many options out there. First of all, of course, you can pick individual stocks, which tend to be more on the riskier side, especially if you are only picking a few stocks. Not saying that that's not possible, but you can have more volatility, hence more risk involved. The other aspect of it is investing in the stock market to baskets of hundreds and sometimes thousands of stocks. Let's say we call them as exchange traded funds, or in short, ETFs. Even for those, depending on how much exposure you want to get to the stock market, let's say 100% exposure to stocks, which is higher risk. On the other side, you can have maybe 50% exposure to stocks and 50% exposure to fixed income, things like bonds or GICs or things of that nature, which are kind of less volatile, but at the end of the day, they're because of the less risk that they offer, the reward that you're gonna reap at the end of the day might be less. But maybe that's more suitable for somebody with less of a risk tolerance. Determining your risk tolerance is crucial. There are questionnaires online that you can easily respond to, simple questions, and based on your responses, it helps you identify what your risk tolerance is. And lastly, what is your saving and investing rate? This is mainly important for kind of having fair expectations. So if let's say you want to invest in the market with the intention of retiring early, as an example. If that's your goal and you are setting a goal of, hey, I want to retire early in the next 10 years, if that's your goal, based on simple assumptions such as 4% rule, which is very kind of a rule of thumb for how much you can withdraw from your portfolio adjusted for inflation without running out of money, you need to make sure that you are actually saving and investing appropriate amount of money into your portfolio. This is the article that I was referencing, The Shockingly Simple Math Behind Early Retirement by Mr. Money Mustache. You can definitely refer to, but it talks about, the 4% rule. And here, the part that I really like, they talk about how many years would it take you you need to be working in order for you to be able to hit that retirement kind of age based on the amount that you invest. So as you see, I'm zoomed in here. So let's say if you're intending to retire within 10 or 10 and a half years, you need to be saving and investing 65% of your take home pay. So at the end of the day, let's say you get your salary, whatever the take home pay net amount is, you need to be saving and investing 65% of it consistently in order for you to be able to, within 10 and a half years, to get to that point of able to retiring early. I have made a video a while ago on my channel that you can see here on screen, Ultimate Guide to ETF Investing in Canada. I'll definitely add the link in the video description for you to check it out. For those of you who are on Blossom, I've also included the direct link on Blossom on my profile for you to easily check out. Even though the video is several months old by now, a lot of the content shared there are actually universal, so still valuable. I do talk about some of the popular ETFs in Canada, dividend type of ETFs for all-in-one ETFs that makes things super simple, ETFs in the US, and many different combinations here. So I do definitely encourage you to check it out if you haven't done that so already. I did speak of Blossom. I want to quickly share my screen. This is the beta version. On the desktop version that you're able to see it here. This is the video link that I talked to you about on my profile. You do see that our portfolio size, as I'm sharing here, is sitting at $824,000, which is quite kind of satisfactory for us. We've been able to build this over time, by patience, diligently investing in the stock market, and we've kept our portfolio simple. Right now, we are mainly investing in 4 ETFs, and to be honest with you, one of them accounts for close to 90% of our entire holdings, which is XEQT, iShares Core Equity ETF. On Blossom, if you haven't checked that out, it's a wonderful community of investors sharing their unique perspectives, learnings. I do actively post on Blossom a lot of different content, so I definitely encourage you to check it out. You can follow my journey, exactly the buys that I have on the stock market through there as well. Through the app, you get a lot more features because, like I said, this desktop version is a beta version for now. With that said, thank you so much everyone for watching this video until the end. If you have any question for me about investing in the stock market or how to get started, feel free to reach out to me by leaving me a comment on YouTube, or even better, kind of follow me on Blossom. There's a direct messaging option on Blossom that you can easily reach out to me, and I have always made an attempt to respond to each and every single message that I've received on Blossom. If you haven't downloaded Blossom, there's a referral link in my video description, and I really appreciate it if you use that. It's free to download. There's no cost for you, and you're definitely gonna love learning and interacting with so many amazing, wonderful investors on Blossom. With that, thank you so much, everyone, and I hope to see you all next time.